Hello, hello, everybody. Can you please let me know in the chat if you can hear me? All right, everybody, super happy that you could hear me. Now I want to ask my guest, Jeff Snider, can you maybe say something to the audience to see if they can hear you as well?
Hello. Hope everybody's having a great evening, afternoon, maybe even early morning, depending on where you're located. Hope you can hear me as well.
Right. Can you let me know in the chat if you could hear that as well? And then if all is set, we're ready to get started. All right. Hello, everybody, and very happy that you joined us all here for another Money and Macro Talks episode. My name is Joeri Schasfoort, and I am the host of the Money Macro and also the Money and Macro Talks YouTube channels. And who I have here with me today is Mr. Jeff Snider from Eurodollar University. And Jeff is basically at this point an educator with a very large focus on the euro-dollar market, making the name Eurodollar University seem like a perfect fit. Jeff, welcome to the Money and Macro Talks podcast and live show. How was that introduction? Does that pretty much sum it up? I wanted to try to keep it as brief as possible, or would you like to add something before we get started?
No, I think that's actually good. Thanks for having me, Joeri. Pleasure to be here. Looking forward to our discussion because it's always a pleasure to talk about Eurodollar, money, and those types of things. Get into the much deeper focus on stuff that I like to talk about. You know, the mechanics, the plumbing, the way things work.
Yeah, excellent. So, Jeff, before we get started, I'm always very curious to know sort of, you know, your main topic is the euro-dollar market. The euro-dollar market is, to me, is quite a bit of a confusing name because we have now this currency called the euro, but I think the euro-dollar term is a bit older than that, and it basically refers to offshore dollars. And it's my understanding, but please correct me if I'm wrong, that the name comes from the fact that this first offshore dollar market was mainly located in Europe and actually in London, is what my understanding is. So I would like to, know from you sort of how did you stumble across this subject? How did you get started on research in or onto the euro dollar market? And then maybe you can expand a little bit on what the euro dollar market actually is.
Well, I started from the very beginning, right out of college in the 1990s, the go-go.com era, when everybody wanted to be a stock analyst, a stock picker. You wanted to be Gordon Gekko, becoming the 1990s version of the get rich in the .com era. And so that meant doing a lot of, breaking down of balance sheets, looking at corporate financials and things like that. Inevitably, you start looking at the banking sector, looking at balance sheets in the banking sector, and you think, wait a minute. This is not the bank. And I'm talking about commercial banks. That's not the kind of banking that you taught in school. It's certainly not what I heard of in college. And so it's like, wait, what are all these things on this balance sheet, especially the liability side? What are these repurchase agreements? Repurchase agreements? Mm-hmm. Where do those come from? What are these Eurodollars? There's Eurodollar deposits everywhere. What is a Eurodollar? You never heard that term either. And so from the very beginning, it was sort of like, there seems to be something going on in the financial system that it's not making its way into either the mainstream public or academia. I mean, what we're taught, I only have an undergraduate degree. I never went into advanced school. So maybe they teach that down the road. But everything that I learned in undergraduate finance and economics, there was no Eurodollars, no repo. Mm-hmm. So I started looking at these things. I started asking questions. And what really bothered me the most was, as a young man in this profession, was nobody wanted to know. It was sort of like, why are you asking questions? We're all making money in .com stocks. Why do you care about Eurodollars or repo? And so it was sort of like, I really want to understand what that is. And of course, that took me into this rabbit hole after rabbit hole after rabbit hole of this monetary system that exists outside the United States, this offshore system. As you said, Joeri, it predates the European common currency by many decades. And honestly, nobody knows where the Eurodollar came from. There was obviously U.S. dollars. There were U.S. dollars running around Europe from the Marshall Plan in the post-war era. But at some point in the middle 1950s, it's sort of more formalized into a marketplace centered in London, a lot of it in Switzerland, as well as other places around the world, where you have this offshore currency market that began to transact in every way like a reserve currency, except it wasn't U.S. dollars coming from the United States. And as we had these U.S. dollars, then became the real Eurodollar secret, which was to move outside of physical currency and just trade bank liability. So it's actually a ledger money system, bank-centered, outside the U.S., transacting in U.S. dollar denominations, U.S. dollar domination that over the decades has subsumed the roles of the global reserve currency. So it's not just a market for U.S. dollars in London; it is the functional means by which all the necessary requirements of a global reserve currency are done. It started out, mainly focused in Europe, but very quickly, late 1950s into the early 1960s, it was everywhere. So a huge component in Japan, Europe, Cayman Islands, Caribbean, offshore banking centers, just offshore. So the term euro dollar is offshore dollar. And there's other currencies that are offshore. There's euro yen. There's even euros. So euro just means offshore.
Yeah, very confusing. I hope that they change the name at some point. But so just to clarify, Jeff, if I, which I have, I have a European bank, and I have a dollar account in that bank, are these actually secretly euro dollars that I own or have a claim on?
See, that's the thing. What are euro dollars? And what euro dollars actually are, in any technical sense, is a paper claim on US dollars. So at one point in the very early days, what used to be called the continental dollar in the 1950s, you had a deposit claim upon, if you have a European citizen, you have a European bank account, you have a paper claim on US dollars. But the actual use of paper hand-to-hand currency is cumbersome. It's inefficient. It's an impediment to friction and commerce. So it's easier just to transact in claims on US dollars. That's how we remove the actual physical currency and simply trade bank transactions back and forth, because you can simply, rather than claiming physical currency and transporting physical currency to exchange a liability, you can just transact through the bank, where they just keep track of who owes what to whom. So we've removed ourselves from the physical currency entirely to just transact in claims on currency. So when you own a Eurodollar deposit, you don't have any actual dollars. You have the right to convert to dollars at some point, but from the very beginning of the system, participants in it realized it's so much more efficient and better to just dispense with the physical currency altogether and just transact in these claims.
Yeah, because this bank account that I have, which I think is technically a euro dollar, right? If I were to do something with this, the most likely thing is that either I would convert it to or send it to someone else who then has this euro dollar account at a European or any international bank, or perhaps I could send it maybe to the US and then convert it it's maybe tricky to say, but to a proper US dollar account. But that's not Fed issued or central bank issued money. That's still, but then US private bank issued money. Is that could I say that?
That's exactly how it works. And it's, again, it's a simple ledger system where, if, let's say, I have a $5 physical Federal Reserve note in my pocket, and you're way over there in Europe, I'm here in Florida, rather than me stick this $5 bill in a envelope and mail it to you, why don't we just transact through a bank, where the bank says, okay, Jeff has this $5 physical Federal Reserve note, and he wants to transact with Joeri over in Europe. I'll just say that Joeri has a claim on Jeff's $5 note. We don't have to transact. That the $5 physical currency can just remain in the possession of whoever has it, and we can just use these claims on physical currency as the actual currency. And that's really how the system developed. And that was the secret to it developing in such a, not just a quantitative increase or expansion, but also a qualitative increase. Because once you remove the need to transact in physical hand-to-hand cash, or even bank reserves from the Federal Reserve, you've given banks essentially free rein to come up with all different kinds of transactions, because that's what it really is. In the example that you just used, Joeri, where you're transacting with somebody on the other side of the planet, let's say, maybe your local bank, you have the Eurodollar deposit with your local bank. They don't have a relationship necessarily with someone on the other side of the world, but they can intermediate through this Eurodollar system to get that transaction done, because the Eurodollar exists in all of these places around the world. So maybe there's your bank, there's an intermediate bank in between, and then there's the bank on the other side of the transaction, and they all connect together in ad hoc fashion, where they don't They don't send physical currency from one to the other to the other. They just keep track of it on a ledger. So Joeri owes whoever's on the other side of it $5. No currency changes hands. We just have these ledgers keeping track of who owes what.
Hey, Jeff, and okay, so I think, this is the technical description, right? Which is extremely important as economists to understand. But one thing that does come to my mind is, why does this all matter? Because it could also be like that, fintech, they use digital technology or, right? Or maybe they're moving to a decentralized ledger. Like, as an economist, I could ask, just to play the devil's advocate a little bit, who cares, right? Like how they do it technically. Who cares? Why does this matter for? And I think I'm especially curious about for macroeconomists, because a large part of money macro is about macroeconomics, about how countries get rich, why countries get into trouble, why they have these huge crises, how autonomous are they? Like, why does the euro-dollar market matter for this? Why does a serious macroeconomist or maybe even a macro investor care about any of this?
Because it goes back to, it's not just this quirk. It's not just the euro-dollar market where there's, some dollars trading around in Europe. Again, as I said, the euro-dollar system is the real reserve currency. And the way it operates actually means how much money is floating around the world. How much money is available to finance actual merchandise trade? How much money is available to finance and redirect foreign direct investment? How much money is there to speculate in one place or another? Because the eurodollar is, as a reserve currency, it is the system that intermediates between various different places around the world. So if you're over there in Europe and you want to invest, you want to build a factory in, say, Malaysia, you got to have access to the eurodollar system, because in Malaysia, while they might take euros, certainly in the early part of the eurodollar era, the dollar denomination and the eurodollar system was the way in which these two different places could talk to each other in a common language using a common medium. And so not only do we have the importance of using that medium, how that medium works and how much medium that there is available for these things to happen impacts everybody, not just those in the US, but everybody around the world. If you want to build a factory in Malaysia, you got to have the ability to get the dollars to do it. As well as if you're in Malaysia, when you get those dollars, you got to be able to use them somewhere. So the eurodollar impacts both sides of the equation as well as everything in between. And to understand how it actually works in the middle, doing all of these these functions of a reserve currency, tells us something important about the economic and wider global macro implications of the monetary system.
Okay, so this eurodollar system, or private offshore dollars. So I actually noticed this as well. Like, I think if you're just in Europe, like I'm in the Eurozone, right? So I typically always use the euro. But then I went into this YouTube space, and here is where I actually got in touch, sort of actually with the eurodollar system, in the sense that I just noticed that all of the sponsors that I have on my channel want to pay in dollars, and even the ones that are not from the US. So even a Canadian sponsor, British, who have the British pound, they want to pay in dollars, and also they, if I sometimes have someone in Pakistan, for example, do an animation, or someone right in South Africa edited a video for me once. All of these payments were in dollars. But not always, like you say, via US-based banks. Sometimes, PayPal, for example, but not always. And it's true that they didn't even, like, it's not, maybe if I would have pressed them, be real difficult about it, maybe they would have accepted euros. But it was very interesting to me that sort of the standard was just dollars. Like, people didn't even think about it too much. Like, oh, I charged this many dollars, and I now also go, yeah, this is my dollar rate.
Well, that's, I think, Joeri, when you talk about a reserve currency and what it actually is, that's what a reserve currency is. A lot of people, especially in the United States, tend to think of a reserve currency as, we get to price oil in US dollars. That's not it at all. Reserve currency is, as I said, this what was used to be called a vehicle currency, as you are a living proof of that vehicle currency, because you're intermediating through an intermediate currency that allows in Pakistan, they're not going to have much use for anything other than a common currency, as it is for anybody around the world. So if you're accepting payments, you got to accept payment in a currency that's useful to you where you live. And so usually that's your local currency, but Joeri, you probably don't have access to that local currency where you are.
Mm-hmm.
But if you have a currency that's common in both places, then it's really easy to transact in a this intermediate step, which is where the Eurodollar comes in. Because it makes these dollars, which aren't real dollars, they're ledger money dollars, available in so many places around the world, you're easily able to transact in this reserve currency, where you can use the dollar to buy goods and services from pretty much anywhere on the planet. But the secret is, we need the banks that operate this currency, because it's hugely intensive. There's tons of infrastructure. There's tons of logistics that go into it. We need the system to operate at really good capacity in order for it to create the elasticity that we need for reserve currency to work. So it can translate things all over the world, but if it's got to be available in enough places in a predictable way.
When you say elasticity, what do you mean with that exactly?
Because demand for money and supply of money are dynamic, right?
Mm-hmm.
This is the age-old problem in any monetary system. How do you most efficiently match the supply of money with the demand for it? And that gets into a whole bunch of sticky conversations, right? What is legitimate demand? How much is speculative demand, and things like that? But either way, we live in a dynamic world, especially in this globalized economy of the latter half of the 20th century into the 21st century, where you have to have this reserve currency available for this growing globalized economy. So you have to have enough money to meet the needs of all of the places around the world that need the reserve currency in order to grow their prosperous societies. So elasticity is the system being able to meet the monetary as well as credit needs of this growing globalized economy. But Jeff, that's where it gets into some trouble and some tricky issues.
Yeah, and before we get into these tricky issues, this is very different to how most people think about money, and also, even weirdly enough, how they are taught about money, right? Like in the sense that, the basics might be like, oh, money is this sort of fixed supply. It's kind of similar to gold, and then if you go a little bit beyond that, it would be, well, the central bank prints money, and the central bank, I'm not sure. The explanation doesn't typically go much further into how that money then ends up with the demanders of those money, the people who actually need it. But the Eurodollar system and elasticity, as you mentioned, is very different, right? It's thinking about money as a sort of decentralized system that expands and contracts based on either, or not either, the interplay of supply by, I would say, private international banks in the Eurodollar's case, and demand, maybe people like me who operate a business internationally, right?
Yeah, and this goes back to, you're right, because our conception of money usually ends at the official sector, right? There's either physical currency or gold coins in the old days when we had a real gold exchange or gold standard, where we're minted by the whatever local authority. So we're taught that money is strictly, you hear this all the time, that governments have a monopoly on money, when that's never really been true. In fact, there's all kinds of forms of private money all throughout the ages. And as we started out here talking about, we're not even using physical currency or physical money. We're using electronic ledger claims on currency, where those claims have become the currency. So there's really not a whole lot of space for the public sector to begin with, because this is strictly a bank-centered system that creates the elasticity that's required for the global system, which is one of the reasons why the Eurodollar took off the way it did, because it's, as a bank-centered profit motive system, it can respond to the needs of its customers all over the place, because it is decentralized, because there is a profit motive there. You go back to the late Bretton Woods era, something called Triffin's paradox, where Robert Triffin realized that the real problem with Bretton Woods was that John Maynard Keynes talked about it with Bancor at the Bretton Woods Conference, Harry Dexter White to a certain extent. But either way, the designers of the Bretton Woods system really didn't foresee a globalized economy and the amount of money and elasticity that would be required for this globalization to take place. Where the Eurodollar came in the middle 1950s was sort of a backdoor way to solve what was called Triffin's paradox, because it could respond. It could be elastic based on the actual needs of the system as it developed. One of the best things, or one of the best attributes for a while of the Eurodollar system, was that it could recreate forms of transactions based on how customers were, how customer needs were moving through time. It could revolve with technology. So the Eurodollar system was extremely flexible. It was extremely elastic, and we could have an argument about whether or not it was too elastic, which it probably was at some point. But for the latter half of the 20th century, we have a globalizing economy that needs this middle currency, this vehicle currency, in as many places as it could possibly be. The Eurodollar solved that issue rather elegantly.
Okay, so could I see it as sort of, as I understand it, at least around the start of Bretton Woods, the money was, for a large extent, gold and government-issued currencies, but also private bank credit creation within their national economies. But that seemed to work fairly well. But on the international scale, it was rather limited. There was sort of a bit of money scarcity in the way that there was more demand, and then sort of
there was lots of scarcity. Scarcity was always an issue, right? As is efficiency. If you're a strict gold standard system, you've got to put gold bars on a boat and transport it across the world, and then you got to wait for that gold and hope that it gets there, that the boat doesn't sink in between. So you have to, in order to have payment actually be discharged in any functional way, you've got to actually transport physical currency. Now, on a limited, more primitive basis, regional economies and then national economies, the actual physical movement of paper, currency as well as money, it's not that big of a deal. But as the world got smaller and smaller, as we became able to communicate across vast distances, there was always the desire to settle transaction as quickly as possible, right? If you and I can send a wire, an old telegraph message where we can extinguish a transaction between us using nothing at the speed of light, using nothing more than a ledger system, that's much more efficient than me having to transact with somebody to move currency, usually with some armed guards on a stagecoach or something, and have it go across the country and hope it doesn't get robbed along the way. Now, that didn't happen all that much, but still, operating in a physical exchange medium is absolutely cumbersome. And what I don't think people appreciate is that we moved to a ledger money system, not with the Eurodollar in the middle 1950s, but really at the end of the 19th century into the 20th. If you've ever written a check, maybe people your age or younger probably haven't, but people my age probably remember writing a check. If you're writing a check, you're using a ledger money system. So this private ledger money system goes all the way back to the earliest 20th century, where really hand-to-hand currency was not a huge part of commerce, really by the 1920s into the 1930s. And so that's another mistake that I think people make, is that even before we get to the Eurodollar, we were operating on a private bank money ledger system inside the US as well as inside Europe and the various countries in Europe too. That ledger money system developed a long time ago. And the Eurodollar, as you pointed out, Joeri, just took it to the next step, just took it
from
across,
national to international.
Yes. Now we're into international, and it goes hand in hand with communications technology innovation. The more that we can reliably communicate at vast speeds and process information, which means computers and computers talking to each other, the more transactions that we can process and settle faster and faster and faster, as long as we're using this ledger money system. So the Eurodollar kind of married the technological and telecom revolution with the desire to efficiently, elastically transact across national boundaries.
So, Jeff, that sounds amazing, right? This all sounds like a fairy tale.
Right.
We have this need for money internationally. The private sector steps in, creates that money, and now we have the wonderful Eurodollar market. So there's nothing to worry about.
Yeah, and that's where the fairy tale usually turns into a nightmare, right?
Oh,
That's the hard money, sound money advocates are already screaming, they're already tearing their hair out because what they've historically speaking, if you have unconstrained monetary creation, the ability to create money at will, and it's not necessarily the case. The Eurodollar system was not constrained by governments. It was not constrained by the amount of physical currency in the vaults, but there were some constraints. They're usually individual bank constraints. But by and large, if a bank could dream up a different way of transacting with another bank, think about things like currency swaps, for example. A currency swap functions every bit like cash and money being transferred, even though it's a derivative of a derivative of a derivative. So if banks are essentially a bank-centered monetary system that is somewhat unconstrained in the ability to create money, all the sound money advocates out there are tearing their hair out because they know where this goes. Because once you allow, you get confirmation bias, you got recency bias to creep in, the bank system, okay, we'll create a little bit more money. And then we'll recreate a little bit more money. Nothing bad has happened, so we'll create a little bit more money. And then a little bit more money. Before you know it, the entire focus of the system goes off of intermediating global financial needs into just let's create money to create money. Let's create money so that we can create our own customers. And that's how you end up with things like subprime mortgages, as well as, all sorts of ridiculous lending programs all over, not just in the US, not just in the housing bubble, but really through the middle 1990s, as I was starting my career, looking at all this stuff, wondering where the hell this stuff was coming from. Yep. From that point forward, because the money creation function was Eurodollar system itself, it eventually went too far. And when it goes too far, it's the same thing that we see every time we go through these boom bust cycles, these bubble cycles. It goes through a nasty period where things are never the same again.
So Jeff, just you were talking about sort of hard and sound money people, and that is basically, so there's this big debate in economic circles, I would say, between indeed, like, should the money supply be heavily constrained or should it be fully elastic? It is quite elastic, but should it be super elastic, I guess? And the hard money people these days, for people who don't follow the historical debate around this, might be Bitcoin maximalists, right? People who say Bitcoin is constrained in supply, and that's why we can never have bubbles in Bitcoin. Well, okay. Anyway, let's speak. Let the evidence speak there for itself. But another form of that would be gold. Gold standard lovers, also maybe known as gold bugs, for example, would say ever since Bretton Woods broke, the last gold standard broke, things have been out of control. And you are giving them here somewhat of a nod that this was a constraint that was let go, and from there on it went out of control, or did it have
the
to
other
do
way
with something
around?
Else?
What I'm saying is that historically, when you look at the monetary innovations throughout history, whenever you see too much constraint on the money supply, humans will invent other ways to do it. The Eurodollar is an example of this. Triffin's paradox was what Triffin succinctly characterizing the situation in the global system. There was a legitimate need for elastic currency that the Bretton Woods system could not supply. And so the bankers in London got together and said, let's invent this system. It wasn't specifically planned, but they essentially worked around that constraint because that's what humans always do. So there is never really a completely constrained monetary system, because if you tighten the screws too much, people invent other forms of money to get elasticity. That's fair. The very first ledger system in history goes back to the 14th and 15th century, when we had something called the Great Bullion. Well, you in Europe had something called the Great Bullion Famine. After the Black Death, for various reasons, there was a lack of silver coin throughout much of Europe. And so in various localities around Europe, they started just writing it down on a piece of paper. So even though money was constrained, there was lack of money available for commerce to take place, they invented a way to do money. So the Eurodollar itself was a workaround from the highly constrained Bretton Woods system that wasn't functioning. So by the time we got to August of 1971, the Eurodollar had already taken over all of the roles from Bretton Woods long before that. I mean, you had the two-tier gold exchange, you had the London gold pool all the way back in 1961. So Bretton Woods had come apart as the Eurodollar came of age because there is a legitimate need for elastic currency, but we've never been able to, find the middle ground, right? The middle ground where currency is just elastic enough to supply legitimate demand for money, but not go too far off the rails into these asset bubble situations. We've always been taught it's an either or. It's either highly constrained or it's unconstrained. What we really need to think about is some kind of middle ground where it can be some of the principles of a sound money system, but not being too constraining, like the gold standard or something similar.
Yeah.
So there's always going to be elasticity. There's always going to be the invention of it.
And I wonder, like, this is a little bit of a side branch, but I just wonder what your perspective is on this, because when we're talking about this sort of hard money, constrained money versus flexible money, and the private sector, like if there's demand, finding a way to create more money anyway, that just completely reminds me of the crypto market situation that we are seeing right now, where they have all of this fairly hard money, not taking into account that anyone can create a similar coin, but then they have created this huge, like more and more, I was researching into the crypto sector, they've created this huge credit system on top of Bitcoin and Ethereum mostly, where they are basically printing, using their terminology, a ton of money in the form of stable coins, in the form of all sorts of decentralized credit, centralized credit. And now they are, I guess, similar to how Bretton Woods met its end, seeing that, hey, if you can do this, you can extend the life of such a system for a long time, and actually you are meeting a legitimate need, and this helps the system, but you still run into this problem where you have this fixed core and this super flexible periphery that gets too big, and
then it has to collapse and implodes, right?
Yeah.
That's really the issue. We've never been able to solve this boom bust cycle, which is really, there's something innately human about it, because as I said, there's always the desire to create more money for whatever purposes, and then we always convince ourselves that as we're doing more and more risky things with that created money, that nothing can possibly go wrong, because nothing has gone wrong. We think about where we were in the 1990s when I started investigating all this stuff. You had all of this massive money creation that nobody had any appreciation of what was going on, yet everybody was convinced there was no risk to it, because number one, everything was quantified by mathematical models, which were pretty much new, and everybody thought, well, this sophisticated math, we'll be able to figure out, we'll be able to predict swings, and we'll be able to predict risks, and we'll be able to predict tail risks and things like that. So we fooled ourselves into believing that there was no risk, that we had solved all of the ancient problems that go with money creation, when we really hadn't. And then all that stuff came to a head in August of 2007. And really that's where cryptocurrency came from. It's not really about, we need to store a value to protect ourselves from the dollar that's about to be destroyed. As you said, Joeri, it's creating more useful medium of exchanges, because the Eurodollar system has been inelastic ever since 2007, because the pendulum swung in the absolute opposite direction. Where we had unconstrained money creation before 2007, now we have the banking system that almost refuses to create money for the risks that it represents. So
that's a credit crunch, right?
Yeah, but it's 15 years long now and still going. It's like at some point, it's a monetary system breakdown. I think that's one of the biggest misconceptions that people have. And it's understandable why that is, because everything you see on TV, all you hear from central bankers and politicians is that QE fixed the world. We had a financial problem in 2007, 2008 with too many subprime mortgages. Ben Bernanke came in with QE and everything's fine again. And everybody has largely believed that's the case. And really, most of the critics of the Fed fall on the other side, where they think the Fed has done too much. They printed way too much money. And that's where, the cryptocurrency, the craze, the bubbles in cryptocurrencies come from. When in fact, the truth is the exact opposite. It was never really about subprime mortgages. It was a global dollar shortage that was caused by the banks operating the system, realizing that there really were lots of risks involved in all this money creation and lack of intermediation. And so once the horses are out of the barn, you can't put this thing back together again. So the banks no longer want to take the risks required to create money and credit that the globe needs. And we're right back in Triffin's paradox all over again, where we have a constrained monetary system, except now instead of the Eurodollar emerging from it, we have cryptocurrencies emerging from it, because humans are trying to create elasticity in an inelastic situation. As I said, as a bank-centered system, it's not about central banks. It's not about governments. It's all about the banks who operate in that system. So people have the wrong idea about what the monetary system has been doing for the last 15 years. They see the Fed's balance sheet explode and think there's too much money in the world. They don't look at the bank balance sheets around the world and see they've contracted over the last 15 years. And really, the Fed's QE is a response to that monetary contraction. It's not a solution to it. It's central banks repeatedly reacting to the monetary contraction in the shadows that you don't see. So people are just confused for very understandable reasons, as I was, 25 years ago.
So I find this very interesting, because I think here we will get also to a point, like up to this point, for people watching might almost try to get, it seems to be too comfortable as agreeing all the time. But I think that's because we've been discussing the basics. And now I think there might be, I'm not sure if we'll have a disagreement, but at least there's something to explore here. But before we do that, because we are live streaming, I always like to do a little bit of a break from time to time and just ask the audience some questions, because this is also a good moment to see I'm with you so far, and to check if everybody is here with us. So this is the moment for everybody. Maybe if you have a question, post it in the chat, and then I will have a look at them, and I can ask the most interesting questions to Jeff. Does that sound good to Jeff? All right. Okay, let me have a look. Well, at least you're getting some compliments already. I see Jack saying, I don't know who
That's always helpful.
Who this guy is, but I like him, so he gets it. Let me see. So this is also, it's not yet a question, but this is also a really interesting comment, I think, by PK, who says, and I think that's true for both of us probably, but okay, let's see if you agree. The more I try to understand about the economy, the more complicated it seems, though I have a background as an engineer. That's
you know what, Joeri, that's kind of, if you take nothing else away from what I'm saying, and what you're saying on your channel is we're taught that the monetary system is really easy. It's all the Fed. The Fed does it, or the ECB in Europe. It's whatever they're doing. It's like flipping a switch. The Fed will flip a switch. The Fed,
inflation.
It's easy. It's no easy. If you take nothing else away from us, understand that it's incredibly complex. And it is more complex than you probably ever imagined in your life. And that's why when we start, when your first question was a really good one. When you think about conceptually what's going on here, why do we care about the Eurodollar system? Because it is so complex, and that complexity, because it's a reserve currency system, it impacts everybody. And whether you realize it or not, it has been impacting your life since before you were born. And it's there all the time. It is the reserve currency system. And understanding that complexity leads you to understand more about what's going on in the world. Not just money and finance, but also social characteristics, politics, everything else that happens.
Yeah, I totally agree with you, Jeff, that the system, and with Jax, who asked the question or made the comment, is just so complicated. And I think people are typically a little bit baffled by that, especially if they're new into the economy, because it seems so simple at first. But I guess, like, if you think about it, there's millions of interacting people. They all have slightly different motivations, and even if they were to be largely profit driven, then they have so many strategies to get that, and they react to each other. And as with the Eurodollar market, you have this Bretton Woods system that seems to be working fine and or fairly good and is nice and tidy. And then the private sector is just developing so many instruments that directly undermine it. And so this system that we are studying is just incredibly complex, and is also evolving all the time. And sometimes even, like, to make it even more complicated, if all economists make up their mind about one thing, then the system might actually adapt to our opinions and do something else.
That's a huge point too, is that when you look at the Eurodollar system today, you have to realize a couple of years from now, it's probably not going to look anything like it. When I first really started looking at this 25 years ago, it has evolved, how many times over. Even over the last decade, the system has evolved even more toward currency swaps, derivatives, more efficient tools to use Eurodollar resources on a bank balance sheet. Whereas in the pre-crisis era, you saw tons of repo. That's the repurchase agreements. You saw that everywhere. Now we're into things like sponsored repo, basis swaps, more derivatives than ever. And so the monetary system, even as it's broken down over the last 15 years, it has become even more complicated and complex, which raises a whole bunch of other issues, and not just about central banks, but also about regulations. It's also about, how do we even conceive of how money works in the system? Our worldview, the common public perception about money is ancient. It's anachronistic. We're way behind. We got to get the public caught up to the 1950s before we even think about the 21st century. And then by the time we get caught up to the 21st century, everything will be different again.
Hey, Jeff, I have some questions here. So I think this is already an interesting one, because you were talking about a slowdown in lending over the last 15 years. And Charlie, who's a regular commenter on the channel, says, do you think the slowdown in lending could be due to insufficient demand rather than tighter credit standards? Or I would say, in other words, rather than insufficient supply?
Yeah, that's always something people raise because they think, well, it's either supply or demand. But why would demand fall off so sharply and then stay down for a 15-year period? It's not like lending just kind of was growing at an exceptional rate and then kind of slowed down a little bit, and that there's just a little bit less demand. It's an inflection. It's a sea change. You see it right at the 2008 crisis. Everything changed. And we know that it's not demand because there's still demand for credit. It's just that we don't see that demand for credit when we look at, for example, public and posted market interest rates. We don't get to see the loans that don't get to be made. So there's demand for credit. We can tell there's demand for credit, but the banks are not willing to supply the money and credit because they're risk averse. To put everything in a very simple bow, to sum up what's the problem here is that when banks saw Bear Stearns fail, and then they saw Lehman and AIG and everything else, all the nationalizations across Europe, they redid their entire business. Banks that used to operate under a risk mentality before the crisis completely changed how they do. If you had some crazy idea to service a customer before 2007, you almost didn't need management approval. You go to you work on whatever exotic desk at whatever bank. You just go to your manager and say, I'm going to make the bank and the customer money. They'd say, go ahead and do it. Nowadays, you got to go through lawyers, got to go through risk committees. You got to go through layers of management that didn't exist before. Banks have become risk averse for good reason. The problem is we need banks to be risk takers in order to create credit and money that the economy needs. So there is demand for money. There's lack of supply for it, which is why we see growth. Economic growth has completely changed. We were growing at one rate before the crisis, and now everybody, it doesn't matter where you look, you see an inflection right at 2008, where economic growth first of all, it contracted in 2008 and 2009, and then the growth after it was much less than before. So there is demand for money. The lack of growth is coming because of the lack of supply of credit, which banks don't want to supply for a number of reasons, including mostly about risk aversion.
Hey, but Jeff, so okay, if I listen to that, I'm of course thinking, okay, could be, but I have also heard some explain this by saying, well, actually, sort of our economies have at least the advanced ones have largely sort of reached their full potential. They're basically done, and they actually reached that already well before 2008, maybe around the 1990s. But then you had this sort of artificial financialization type of economy where everybody went on speculative binges, fueled by credit. And so this is why you see this inflection point, because actually it was a slowdown for all along, but it was hidden by this bubble. What do you think of that view?
No, I don't buy that for at all. I mean, how does that explain the lack of labor participation in the United States, for example? So we've had labor participation drop off dramatically. Where did that drop off? In 2008. Was that because we had too many workers being employed in the pre-crisis era? I don't think so. I think the labor market problems that we're seeing are consistent with the lack of money and deflation, as we've seen time and time again. This is why we look at the post-crisis era in the United States or Europe or really anywhere around the world, including China, Asia, emerging markets. You see the lack of labor participation, which is a symptom of deflationary. Japan in the 1990s, the Great Depression. It's not lack of demand. It looks like lack of demand, but it's actually lack of money constraining the real economy, the ability of entrepreneurs to take advantage of ideas and to hire workers. So lack of money becomes lack of credit, becomes lack of use of labor that's available for you. And so you have in the 1930s a huge reservoir of unemployed workers. In the 2010s and forward, we've hidden that reservoir of workers because we say they're not part of the labor force. But either way, it works out to the same problem, which is that we have an economy that's in trouble because we're not supplying the money and credit for it. And if we would do that, you would see labor force participations rise again because companies would be able to take advantage of this massive resource that's otherwise sitting idle. And if we were operating anywhere close to actual potential and efficiency, we would not have this large reservoir of labor in pretty much all these locations around the world.
So I think that's interesting. It's different from the views that I often encounter. Do you think that this might explain sort of why we, when I look at, I was based in the Netherlands and Belgium, there after COVID, these economies have indeed shown that there was a lot of space in the sense that now sort of people are able to find jobs much more easily than they were for the last 10 years or something like that. Of course, we do have huge inflation at the moment as well, which might also have something to do with massive oil shocks and lockdowns, but I'm sure we'll get to that. But do you before we get to that, do you think this sort of have we been now for the last year or so been exploring in Western Europe and the USA, for example, this stage where we are activating this demand, where we have more supply?
I don't see it's tough to really figure that out because we had the sharp break where in 2020 everything shut down, and so did we actually reduce potential even further in 2020? I mean, that's a possibility. But one thing we can say for sure, up until 2020, no economy was operating anywhere close to potential, because time and time again you heard policymakers, especially central bankers and economists, talk about, okay, we're at full potential. Look at the unemployment rate in the United States. It's as low as it's been in 50 years. We're going to get wage inflation because we're operating at potential. And guess what happened? Never got the wage inflation. Never showed up. As Janet Yellen said in 2014, maybe there's hidden macro slack here that we're just not accounting for in the unemployment rate, which, I mean, only makes sense. Why is the participation rate in the United States so low? You can either blame the workers that aren't working, or you can blame the macroeconomy and macroeconomic circumstances that aren't producing the jobs that bring people back into the labor force, which is what's supposed to happen in a recovery. So that leads us to either blame workers, they're either lazy or drug addicted, as economists have tried to claim all this time, or there's something wrong, a macro factor that's preventing companies from taking advantage of this reservoir of labor. And when you look at the charts and the graphs and the data, they all point and converge on one particular point, and that is 2008. What happened in 2008? We know what happened in 2008. It wasn't subprime mortgages. It was a monetary breakdown that represented a complete radical shift in the way the monetary system behaves. And we know that not just from macroeconomic data, we know that from all the financial data too. We look at market prices. Why were interest rates so low in that 15-year period? Not because of quantitative easing. Quantitative easing has almost no effect and no impact on interest rates whatsoever. I know people don't believe that. You don't even have to take my word for that. Look at all the academic studies produced by the central bankers. They'll tell you the same thing. It's the interest rate fallacy. The interest rate fallacy is that when rates are low, that means money is tight, not loose. It's not stimulus. Bond yields, when the demand for safe liquid instruments is through the roof, that means safety and liquidity are being prioritized because money and liquidity are in short supply. What we saw in Japan in the 90s, what we saw in the United States during the Great Depression, Europe too, interest rates go low, and they stay low because this lack of money, lack of credit creation produces a high level of demand for safe liquid instruments, which also means you aren't, if you're a bank and you're owning treasuries because they're safe and liquid, you sure as hell aren't going to be lending to mom and pop. You're not going to be lending to small and medium-sized businesses. And what did we hear in Europe over the last 15 years?
Wait, Jeff.
We need to get credit to small and medium-sized businesses because
Yes.
the banking system is not filling that need.
Jeff.
So it's a comprehensive picture here from labor demand, lack of participation, focus on 2008, clean break, the monetary system, the financial indications, they're all telling us the same thing. The problem is most people are taught everything that they're taught that low interest rates are because central banks want them low. They're taught that low interest rates are stimulus. Nobody knows how to read yield curves. Nobody knows how to read all these financial signals. And so this idea has propagated for the last 15 years that QE, the economy's fine, look at the unemployment rate, all these other things, when you have all of this mountain of data over here that tells you, no, it's the opposite. There's lack of supply of money because banks have completely changed the way they operate.
Okay, Jeff. So there was already so much in here. I think that you went through quite fast. So let's unpack some of that. And I have seen also some other questions, but first, because I think this is quite a difficult topic and quite contrarian to many of the views that you usually hear or see. Let's unpack some of this and then get back to some of the questions that I haven't forgotten about. Just to the viewers. Okay, this is already one thing that you said is super controversial. Quantitative easing, like what's not controversial is that it doesn't really do much to the real economy. I think this is not very, if you say that, like it didn't have so much of an effect on the economy, this is not very controversial. But if you say quantitative easing didn't even lower interest rates, that's a controversial statement, right?
It's actually not. It's really not.
Well,
if you read any of the studies, they show you any meta studies that you look at. And again, these are not my studies. These are studies that were produced by central banks themselves. And they show you, there was a recent one from last year. I think a professor from University of California, the widely cited study that showed that 600 billion in U.S. Treasury purchases in the United States is equivalent to 15 basis points on the 10-year Treasury yield. That's no effect. That's nothing. And Joeri, all you got to do is look at the charts. Look at the charts when the Fed is buying U.S. Treasuries and see what the behavior of yields are. There is no correlation whatsoever. So I actually think they're being charitable by saying there's 15 basis points. There's other studies that say maybe it's 40 or 50. But if you have to do 10% of GDP just to get 50 basis points in reduction in treasuries, that's a rounding error. That's not statistically significant. And in fact, usually that's why most of these studies try to claim that the effect from quantitative easing isn't in lowering interest rates, it's actually lowering term premiums, which is basically saying we can't find a detectable amount of effect on interest rates themselves. So we're going to assume there's a reduction in term premiums, which is something economists have made up because they don't really understand the bond market anyway.
What's
so
the term
it doesn't
premium?
matter what
Can
study you look
this,
at.
Jeff, briefly. Can you briefly explain what a term premium is? Because I don't think everybody
you
knows
sure
that.
you want to get into that?
Well,
we look at Fishery
simply,
and
I mean,
decomposition.
if you bring up the term, I think we should explain it just in the simplest form possible.
It was sort of a throwaway, but okay, fine. Fishery and decomposition. What is a long-term bond yield? Well, Irving Fisher in the early 20th century said a long-term bond yield is nominal growth and inflation expectations. Later, under Robert Lucas's rational expectations paradigm and some of the other work in the 1970s, they said, well, maybe there's also a third component in bond yields, which we'll call a term premium, which is what we expect that if you own a 5-year bond, then you probably want a little bit more of a return to own a 10-year bond because you're owning it for a longer period of time.
Yeah,
it was economists' way of trying to figure out why yield curves were usually upward sloping.
Yeah, so indeed, like
we're just going to assume,
and that makes sense, right? Like if I can buy that if I don't invest that much, but that for a 30-year-old Italian government bond, I want to have a higher interest rate than for a 1 month Italian government bond.
It's intuitive, but that's not. It's completely made up, and it's not really how it works.
Okay, interesting.
The real truth is that we live in a dynamic world where various participants are operating at different parts on the yield curve, and sometimes they have different perceptions about growth and inflation expectations at different points around the curve. So, for example, what are the yield curves look like right now? We have a downward sloping yield curve. In the United States, it's ridiculously downward slope. Even in Germany, the German yield curve is downward sloping right now. How do we make sense of that?
Well, I think I've seen some theories there that this has something to do with the Eurozone, where there's not enough safe assets, and so there's sort of excess demand for German.
But that would be the
bonds.
other way around.
What do you mean?
If the problem, and that's true, by the way, the European 2-year Treasury is the German 2-year shots is the most highly prized of collateral in the euro-denominated zone. But if there was an excess of demand, then you would expect the price to go up on the 2-year, and then the 2-year yield to fall below. But either way, what we find is that term premiums are nonsense. Term premiums, at least what I find, I know academics don't agree. They love term premiums. Mm-hmm. Fed talks about them all the time. Fed economists talk about them all the time. Alan Greenspan's famous conundrum. It was all about term premiums. But essentially, what we have is that bond yields behave independently, which is something economists, I don't know why they don't understand this or they don't want to believe it, but bond yields behave independently, which just explains why we have an inverted yield curve right now.
But what do you mean when you say they behave independently? What does that mean?
Essentially, we're taught to believe that the Federal Reserve or whatever central bank controls the front end of the yield curve. And that's true to a certain extent.
Yeah, so that's
they have a high degree of influence at the front end of the yield curve. The way Alan Greenspan explained this in front of Congress in 2005 was that you can think of the yield curve as a series of 1-year forwards. And so if the Fed sets the first forward, then all the rest of the years are going to fall in place because you're setting your expectations based on the forward in front of you. Mm-hmm. So if the Fed sets the first year forward, then you're going to add a little term premium for the second year, add a little more term premium for the third year, and essentially this hubristic belief that the Fed can then control the entire yield curve, all based on term premiums.
Yeah.
So if the Fed raises the short-term rate, which is the first one of those forwards in the series, all the rest of the forwards should come into place, right? They should just lock into place based on consistent term.
I think the theory is that so I think the theory is that they should do something, right? If you move the short-term interest rate, and then maybe like if you do
all interest rates should fall in line based on what you do to the short rate. But history shows that's not the case at all. So economists believe that interest rates are controlled. They're not independent. They're dependent on the short-term rate, and that all rates are basically set from short-term rate and then the risk-free rate on the yield curve. When time and time again, especially in the last 15 years, you see that interest rates are not dependent on that front rate. That's where inverted yield curves come from. It's where negative swap spreads come from. We've seen the financial market where long-term rates act independently because of different participants in the marketplace, different incentives, as well as different competing views with the Federal Reserve or whoever's influencing the short-term rate.
But okay, Jeff.
Well, it goes back to our original premise, which is this stuff gets really complicated. Yeah. It's not as simple as they make you believe it is.
Yeah, but I do think we're going a bit too fast now through sort of this is very, very theoretical. There's a lot of terms here. So if you
see, that's the thing.
Let's break it down a little bit.
This is less theoretical and more practical. I see the central bankers and mainstream economics going too far into theory and not being able to marry their theory with practice.
No, but what you're saying is theory as well, right? What you're saying
exactly.
is a theory.
QE is supposed to be powerful money printing. It controls interest rates. It helps the Fed and whatever central bank set the short-term rate, set inflation expectations so that it can control the long-term the yield curve. When all these money curves are continuously, that was Alan Greenspan's conundrum in 2005. What he was telling Congress is, we think of the yield curve as this series of 1-year forwards, but guess what? The long end of the yield curve is not behaving the way we thought it was. Our theory was this series of 1-year forwards, but the long-term rates were not rising the way the Fed wanted them to.
Yeah, and that's why they introduced quantitative easing to manipulate the entire
central banks
curve, right?
are off into theory, and in practice they can't make sense of why time and time again their theories don't add up. And the answer is this monetary system in between their theory and reality. When you factor the Eurodollar system and conditions in it, you can see why they think QE is supposed to do this, and reality instead goes in the opposite direction. You can then begin to explain why the theories never match up to practice.
Okay, let's get into it. So the euro-dollar system is the thing that's messing up central bank theories, and you've discussed. I just want to quickly sort of explain for everybody listening that sort of when we talk about a yield curve and like there's all sorts of interest rates in the economy. The shortest term interest rate, meaning hey, I'm going to borrow from you overnight and going to pay you back tomorrow. That is thought to be set by the central bank, and I think there you agree to a certain extent.
Even that's much more complicated.
To a certain extent.
Because there are any number of times when you see short-term rates deviate from monetary policy targets too.
Mm-hmm. Yes.
T-bill rates, collateral, you just talked about. Collateral shortages, safe asset shortage. You see that all the time in the United States. Up until recently, the 4-week Treasury bill was 40, 50, 60 basis points below the RRP, which is, wow, that's only explained by a collateral shortage. So again, we see even in the short-term interest rates that it's not as easy as the textbooks say. There's other things going on that you have to pay attention to and factor. Yeah. But by and large, the Federal Reserve or the ECB, whatever central bank, does have a high amount of influence in the short run on the short-term end of the yield curve.
Okay. So I think that's good. So that's our basis, right? That's where we're starting from, and then you have, of course, if you look at the economy, you don't just have the short-term interest rate. Most people, they might know a mortgage. That's a rate for 30 or 20 years, for example. That's at least common here, 20-year mortgages, and that's a longer-term rate. That is typically higher than this short-term rate, right? Like even if I have a deposit at a normal bank, that's something I can get out of the bank in cash tomorrow if I want. That's a short-term rate. I get there. The mortgage rate is typically higher. So that's what the economists and investors like Jeff say when they mean when they say that the yield curve is upward sloping. So short-term rates are lower than long-term rates, right? And then the central bankers were thinking, if we can control the short-term rate, and they even got Jeff along with them to a certain extent, debatable, but they were much more confident, like you say, we can also change these long-term rates, right? And they move completely with our short-term rate because the term premium, so the difference, is fixed, right? That was the classical assumption, I would say, no?
That's right. If you're Greenspan in 2005, remember the Fed was raising rates at the time, and what he was thinking is if I raise the short-term rate, which was at the time just nothing more than the Fed funds target, again, this perception is really simple and easy. All they had was a Fed funds target, and yet that was supposed to control everything.
The short-term
rate. But Greenspan is thinking, I raise the Fed funds target by 1%, for example, why wouldn't the 10-year Treasury yield also go up by 1%? You would think that it's a one-to-one relationship. In fact, again, that's what he was saying, this series of 1 year forwards. If you raise the first rate in line by 1%, every single one should rise by the same 1%.
Yeah.
But what he saw in practice was that he raised the short-term rate by about, I think at that time, was 75 basis points, and the 10-year yield was lower. It didn't go up at all. It actually fell. And so he was telling Congress that this was a conundrum because to the central bankers, all these interest rates are dependent on the short-term rate.
Yeah.
He didn't believe that interest rates in the financial system would act independently, and they've only become more independent since the financial crisis as the monetary system has broken down.
Yeah.
So again, going back to our original premise here, the situation is far, far more complicated than what you're taught or what you see on TV or what comes out of central bankers' mouths. Because what Alan Greenspan called a conundrum in 2005 was nothing of the sort. There was no conundrum here. He was just wrong.
So why was he wrong? Why, he raised, I think, right? The short-term interest rate. Long-term interest rate fell. What's your explanation for this?
He was raising short-term interest rates because his models, all the econometric models, Furbis and all the ones the Fed uses, said that the labor market was getting tight, the U.S. economy was in danger of overheating, and that nominal inflation was the biggest risk to the U.S. economy. And if he was right, then interest rates would have behaved exactly as he expected. Long-term yields would have gone up because, again, Irving Fisher, if the market believed that nominal growth and inflation expectations or nominal growth and inflation potential were rising, then you would need to be compensated for higher inflation down the road. So either Greenspan was wrong about inflation risk or something else was happening. And that's really what the case was. Greenspan thought that we need to raise rates because inflation is going to flare up in the U.S. when those participating in the financial markets say, oh, no, the biggest risk to the U.S. economy is deflation.
Right.
This whole housing bubble thing that the Fed was just ignoring, maybe that's going to be a problem. And instead of nominal inflation happening down the road, we're going to see nominal deflation and all sorts of negative economic growth consequences from it. Guess who was right?
So
the independent long-term rates pegged the housing crisis before the Fed ever figured out there was a problem, which is really what inverted yield curves tell us. They're telling us that the market is thinking something very different from what the Federal Reserve or those who are influencing the short-term rates are. Right. So think about this in the context of 2022. The markets are saying rates are likely to go down. We're not seeing inflation. We're not seeing growth go up. We're seeing all the things that Irving Fisher talked about, meaning we demand lower. We're okay holding a 10-year U.S. Treasury that yields more than 1% less than the 12-month Treasury bill. Why is that? Because the market is projecting growth and inflation expectations are going down. Now, you can say that's because the Fed's being incredibly effective in raising rates and in cutting inflation, but the yield curve has been inverted for long before the Fed started hiking rates. The market has been thinking about lower nominal growth and inflation expectations independent of what the Federal Reserve says or does or forecasts. So just like 2005, we've got the long end doing something very different from what the Federal Reserve is doing at the short end.
Okay. So you're saying, the Fed has quite a bit of influence on the short-term rate, but not the long-term rate, because lots of other factors play into this. For example, if market participants expect deflation, that effect can be stronger than the effect of the short-term interest rate going up, and hence we could see this difference.
That's why you usually see the start to hit right around the 2-year section of the yield curve. Because you think in the short run, absent some immediate threat that everybody can see, you think, well, if the Fed says it's going to raise rates for the next little while, it's probably going to be able to get away with that, right? Because the Fed is always a reactive, lagging perceptions. So you see this in Eurodollar futures, you see it in the yield curve, whatever the case may be. The Fed has a lot of influence at the short end until whatever it is that's bothering the marketplace, so that they're hedging by buying longer-term instruments, safe and liquid again, until that becomes an immediate danger, the Fed can influence the short end independent of the long end, which is why you see these weird yield curve shapes like we see right now. Because the front of the yield curve is saying the Fed's going to raise rates for the next little bit, and then something's likely to happen from there on, which is going to lead to lower interest rates in the future.
So I think this is interesting because I think it brings us back a little bit to an ancient debate in economics, which is about who controls the interest rate. Is that the central bank or is it the market? And the way I see your answer, but please correct me if I'm wrong, is that you're saying the market sets, like first of all, there's not one interest rate, there's multiple interest rates.
Yes.
The market sets almost all of these interest rates, and the Fed maybe is wiggling around with a short-term interest rate, or the central bank is wiggling around with a short-term interest rate. But if it gets too far out of step with what markets would want that to be, you get these weird yield curves. In other words, the central bank is basically manipulating the market there a little bit and not achieving what it wants.
Yeah, the market, in the very simple terms, ignoring all the complication, because you're right, because again, it's incredibly complicated, and there's not just one interest rate, or there's not one series of interest rates. It's all number of interest rates. But there are times like this when they're all telling you the same thing, which is that the market expects rates to be lower at some point beginning relatively soon. They're going to head lower probably pretty quickly. And the reason is, going back to our original premise, where is the money created? The money comes from the banks who are trading in these U.S. Treasuries or these various derivatives.
Mm-hmm.
We're looking at the monetary system. Tell us what's going on in the monetary system. It's independent of the Fed. The Fed doesn't create any money here. The banks that buy all these treasuries, that use these as balance sheet tools, they're telling us what their perceptions of the intermediate and longer term are. They want to own safe liquid instruments more so the further out you go in time. And so that tells you something very important about what the monetary system participants are thinking about, not just macro problems, but also monetary potential too. So that's why you have this massive upset in the yield curve. In fact, the higher the Fed has hiked rates, and this is true in the Europe too, the higher the ECB has hiked rates, the more distorted you see these curves, which is basically, again, putting it in very simple terms, the market is disagreeing with the premises behind the rate hikes.
All right. So, okay, I think this is really interesting, and we're gonna get to quantitative easing now, I think, because
we should go back to that.
Well, I mean, we haven't really talked about it. You talked about it, but what I liked about this little discussion now is that we slowed it down a little bit to talk about interest rates and the yield curve, which is a very complicated subject. And quantitative easing plays a big part in that, right? Like, so the idea was first, like you mentioned, the Fed can just control the whole yield curve with its short-term interest rate. Well, practice sort of showed that's not the case. So, but the Fed, these are very smart people, right? Like they adapted. They were then like, okay, we're going to try something new. That's quantitative easing, because we have set rates as low as we can go without, too much more weirdness going on because of negative interest rates. So we're going to do quantitative easing, where we're going to buy all sorts of long-term dated securities with an interest rate. And so by taking them out of the market, we're also lowering the long-term interest rates. That's the idea. But you are saying, if I hear it correctly, that's not how it works. And that definitely needs explanation, because that's very different than how people think about it.
I know, and it sounds plausible, right? It sounds even intuitive. If the Fed is buying, or the ECB is buying bonds, why wouldn't that raise the price? Because you have a non-economic buyer coming into the marketplace that wouldn't exist otherwise. But that's the assumption, that without the Fed, interest rates would be higher. And that's not true. In fact, if you read the discussions and the transcripts of the Fed meetings, what you see is they realize they're buying bonds that the market is already buying. They're not adding an extra buyer to a market that doesn't have them. They're adding to a market that is buying more and more treasuries anyway, which is why you find very little effect from quantitative easing on interest rates, because interest rates are already falling before the Fed starts buying them. As Richard Fisher, the famous quote that I always use is, he said, "Why are we buying assets that everybody's fleeing toward?" In other words, the market is already buying safe and liquid instruments for the same reason the Fed is buying them. The Fed does QE in response to a deflationary shock. And guess what the marketplace does in response to a deflationary shock? It buys the same bonds. So the market is already lowering interest rates before the Fed even gets there, which is why at most you can say is there's a slight correlation. Maybe some of it's causative, but that's why it's only tiny bit. Interest rates are already falling by the time central banks start buying. And that's where it really, again, if you don't realize what the system is doing and why the system is doing it, and you're solely focused on what the Fed is doing, you're left confused. You're left wondering, why does this quantitative easing never seem to produce the results that everybody says? I mean, when you talk about quantitative easing, going back to the very first one in March of 2001 in Japan, everybody said they're pouring trillions of yen into the real economy. None of that happened. It doesn't happen at all. It doesn't do any of the things that it's supposed to do, because the situation is far more complicated. And in terms of just lowering interest rates, deflationary shock, market wants safe liquid instruments, rates on safe liquid instruments go down before the Fed even buys the first bond. So the Fed is piggybacking on what the market already does, which is why these studies don't find much results from QE, because it's already taking place anyway. You can't assume that the Fed is buying bonds that the market won't, because that's a bad assumption.
So again, there's again a lot here, but I just want to say that, okay, for me there are 2 points here. I think one you're mentioning, and that there's a large part of, let's say, the media that would say like, oh, they're printing money into the real economy. But to me, that is, that's true, and I often fight that idea. But I think there's also already a broad segment of at least economists who would say, no, that's not the case. What banks are actually doing is creating interbank money. They're creating reserves, that this doesn't end up in the real economy. So that again is not so controversial, I would say. But then you're saying, hey, there's a run on safe assets. But I think central bankers know that, but there the theory is...
No, they don't.
Well,
I think you're giving them way too much credit. I've read
many
through
central
pretty
bankers...
much every FOMC transcript over the last, 50 years. You are giving them way too much credit.
So, okay, maybe I have a bias here.
No, you're right. Look,
I will admit.
These are smart people. They're not dumb. They're not evil. They're not anything. The problem is they have a very outdated worldview, and they can't make sense of the world that we actually live in. And so that leads them to do, they never should have done QE in 2008, 2009 to begin with, because they already knew it didn't work in Japan. They knew it didn't work in Japan, and they also knew why it didn't work in Japan. Why did they do QE anyway? Because they didn't know what else to do, which was the real reason why they did it in Japan in the first place. So they reanalyzed everything that went wrong in Japan and said, if we get in that situation, maybe we'll do it better. But they didn't do it any better. They did the same exact stuff that happened in Japan, and they got the same results as the Japanese. And what do they do in response to that? We'll do more QE. They just keep doing one QE after another, after another, after another. The QEs never end. Japan's on their 26th. QQE's been ongoing for almost a decade. In the United States, how many QEs have we done? We're up to 6. The ECB, QE really ever since 2015. It's one QE after another after another. I think you're giving these central bankers way too much credit, because in response to the repeated failure, any scientific discipline would say, this doesn't work. We need to figure out why it doesn't work and not do it again. Whereas the central bankers say, we don't know what else to do, so let's do more QE.
Okay, Jeff. So so one thing I want to ask you here is, okay, look, I'll admit that I might have a bias here, because what I do is I read central bank economists, fairly academic ones, that I find interesting, right? And they typically do write about the shortage of safe assets. For example, there are quite a few researchers at the Bank for International Settlements that I think have quite a good view on how sort of global finance works. And they do often write about this, and they do these speeches and all of that. Okay, fair enough that not all central banks do that. But let's talk about these ones a little bit, where the view is, yes, there's a shortage of safe assets. But what we're doing with QE is we're taking one safe asset, treasuries or bonds, out of the system, but we're adding an even safer asset, and that is reserves. What do you think of this?
And that's the worst thing they could possibly do. Again, they don't understand. You're taking a safe asset that's usable as collateral in repo and derivatives, that's necessary in collateral and repo and derivatives, and giving them a useless bank reserve. And it's actually harmful. They're actually causing a bigger problem. You could make a better case for QE being deflationary and ineffective and actually harmful than you can for QE helping in any one of these channels. Because we have a collateral shortage. Again, as I mentioned before, the reason the 4-week T-bill rate was so incredibly low is that there's not enough T-bills to satisfy the collateral system. So as a shortage of collateral, the answer is not to remove more collateral from the system and give the system back these useless inert bank reserves. See, they're looking at the safe asset shortage in the wrong way, because they don't see the larger implications for the other parts of the way the Eurodollar system works. Repo, derivatives, they're all collateralized. And so collateral forms its own currency stream. Yet we're taught to believe that reserves are more important and more of a better safe asset than useful collateral, especially. This is the worst part, because collateral is reused, repledged, rehypothecated. So when you remove one bond from the collateral stream, you're actually removing several different instances of it being used. You're breaking down more and more funding chains of interbank transactions all throughout the system. Okay. Yet they think, they see that there's a safe asset shortage, but they don't know why. They don't know what it really actually means. And that's because they're starting from this worldview that's outdated.
So okay, but now in my view, we're moving towards a new part of the euro dollar system. So I think we understand. We have talked briefly about that banks are and global banks in particular are a big part of the euro dollar system, right? They create these offshore dollars in the form of deposits. But and this is perhaps a bit more of a newer development. There's now academics call this the shadow banking system. And in that, they refer for a large part to the repo market, which is whole new, fairly unexplored. At least, like you don't
See,
get
that's the
taught
thing.
about
It's
it in
not
university.
new. The repo market developed
True.
in the 60s and 1970s. And
True.
the problem is there was a lot of good scholarship in the 1970s in particular. But what happened was monetary policymakers under Volcker in particular said, this stuff is too complicated for us. We can't make heads or tail of it, so we're just going to ignore it. So the repo market, that's not a new development. The repo market became a huge important innovation of money market funds and the development of wholesale markets. Repo was a huge part of the system by the 1980s into the 1990s. And in fact, if you force me to describe the 2008 crisis in a single word, I would say collateral. It was repo. It was a collateral shortage. So that's already 15 years ago. And here we have policymakers just now starting to catch up on the fact that, hey, there's a safe asset shortage, and they still don't realize the full range of implications of it, because now it's not just about repo, it's also about derivatives. These currency swaps, the Forex derivatives that are used more and more in place of repo are also collateralized too. So collateral has been a huge part of the Eurodollar's development for decades. And it makes sense why that would be. Because if you are, if we're transacting a couple of banks across the world, we likely don't know each other. So if you need a few dollars and I have a few extra dollars and you want to borrow them from me, I don't really know you. I need some collateral, right? I need some security that I can be reasonably assured that you're not going to screw me in default on the loan. So from the very beginning, this wholesale Eurodollar stuff that started from 1960s into the 1970s, collateral has played a central role. What happened, what was different, is that central bankers in the early 1980s turned a blind eye to all of this stuff because they said we can control everything with a single interest rate. They really believed that they could just ignore the details of the monetary system and just influence bank behavior by raising and lowering the federal funds rate in the US. In Europe, it's been a little bit different. But either way, this hubristic idea that we can control everything by just the front end of the yield curve, when it's all these other complications are far, far more important. In fact, again, as I said, you look at 2007, 2008, that was a collateral shortage. And that was not talked about anywhere, nowhere. They never talked about it. In fact, there's a quote from 2008, Bill Dudley, who talked about you could see that there was a collateral shortage in the weeks before Lehman failed, because again, the 4-week Treasury bill rate was well below the federal funds target. And Bill Dudley said, nah, this is no big deal. Everything's fine, when everything wasn't fine. That's really, when you boil it all down, central bankers and many economists are looking, they haven't caught up to the 1970s, let alone the 2000s and the 2020s, where we're going from here.
Right. Okay. So I agree that the repo market is quite a bit older. I mean, I think it's even way older than that. I think, when Britain was still the center of the financial world, the repo markets, I think, already played an important role. But just to get everybody along with us, repo contract is basically a swap, right? Like I give you a bond and I get cash back. And in return, I promise that I will do the same thing again tomorrow. So I'll give back the cash and you give back the bond. And in effect, I think this is a very convoluted way, I think, for many people. But it is short-term. It can effectively be seen as short-term borrowing, as another arm of borrowing. That's what it is. Right? Yeah.
The only reason it's called a repurchase,
difficult for people,
believe
right?
it or not,
if you swap
you're
something.
Right.
It's very difficult.
It's really just a collateralized loan. It's not really a swap. It's a collateralized loan. And the only reason it's called a repurchase and thought of as a repurchase agreement, because of the Federal Reserve. In the 19-teens with World War I, the Fed was prevented from financing speculation. So the Fed decided, well, we're not going we're not going to let commercial banks use the discount window because that would be against the rules. So instead, we're going to pretend that we're going to buy a bond from the bank and then sell it back to them the next day. When really all that is a collateralized loan to work around, to circumvent the laws that exist at the time. So it is a collateralized loan, and we only call it a repurchase agreement because of that ridiculous beginning to the modern use of it. And you're right, collateralized loan go back to the beginning of loans. From the very first loan, there's always been collateral. What's different now, what the Eurodollar took to the next step, was in making collateral itself extremely fungible, which means that without getting too far down this rabbit hole, which this is a whole other one, there are dealer banks. Let's start with a simple example. Let's pretend that you're a hedge fund and you want to speculate on risky assets, because that's what hedge funds do, right? And so that means that you're going to buy, say, a junk bond because its yield is much higher than safe and liquid, so other safe instruments. However, being a hedge fund interested in maximizing your profits, you want to borrow, you want as much leverage as you can possibly get at the lowest cost leverage. So if you go to the repo market with this junk bond, you're going to get a huge haircut. You're not going to be able to lever up as much as you would as if you had a U.S. Treasury. Because if you go into the repo market to borrow cash with the U.S. Treasury, you can get a much better deal, more leverage, more efficiency, more funding leverage, therefore you're much more profit. But you don't have a U.S. Treasury. So you go contact your local large dealer bank and say, do you happen to have a U.S. Treasury? And the dealer bank says, well, I don't have one either, but I know somebody who does. All these insurance companies and pension funds, they have tons of treasuries. The government makes them have treasuries. And guess what? They'll rent them to you for a fee. Not sell them, rent them. So now you have a four-legged repo transaction where the hedge fund presents a U.S. Treasury as collateral and repo to borrow on the best terms. It doesn't own the Treasury that it just used as collateral and repo. It borrowed it from a dealer who borrowed it from an insurance company. This is called securities lending, and the securities lending businesses of all these firms developed in the 60s and 70s. So even collateral is much more complicated than it's ever made out to. Even for the few people who talk about collateral, it is ridiculously complicated to the point that this reuse rate becomes an important factor in determining if there's enough collateral or not. Because if dealers are not willing to do the securities lending,
Is that similar to like the velocity of collateral, the reuse rate? Like
yes.
If you think about the quantity theory of money or something.
You look at the collateral, it's like its own currency system. There's a multiplier. There's a velocity. All of this stuff. And it all is determined by the banks operating in it, the securities lending practices. And that is why the 2008 crisis became so bad, because one of the primary conduits into that was AIG borrowing treasuries from its own regulated insurance company subsidiary. Yeah. And once they couldn't do that anymore, safe asset shortage, no, collateral shortage. And then you have not just this one company that doesn't have collateral, it's not reused either. So you have a multiple of that breakdown, which gets spread everywhere.
Hey,
so collateral is just, it's even more complicated.
Jeff, we're really far down a rabbit hole now at the moment, I think. Just so let me just try to at least point people to where we are at now. I think that, like, you know, when you're discussing about the Eurodollar system, or the global financial system is perhaps in this case a better word, you can talk about global banking, and then repo is it's also what people call shadow banking, and then there are all sorts of markets around that as well that I think economists also refer to as shadow banking. There's money market funds or money markets, and then, as you say, like, well, how did you call it again? Collateral lending markets? Was that?
Yes, securities lending.
Securities lending. And these are all interrelated, and this is really sort of like high level stuff. And I do want to get back out of this rabbit hole a little bit, because, you know, I think so I taught a course called International Banking and Finance at the University of Groningen with Professor Dirk Bezemer. And this was a master level course, and this was really difficult. And we're now sort of like talking at a level where I think my students that completed that course, that did talk about shadow banking, repo, and all of that, would have a hard time following us. So I do think we need to bring it back a little bit. But I do hope that people take away from this that there are these very interesting layers in the huge global financial system that you just have to start peeling back one by one. And this brings us to some of the questions that I did earlier see, because Jeff, some people were asking me if I want to know more about this huge financial system. But I want to take it a little bit slower than our conversation right now. Of course you go to Eurodollar.university, right? Of course. But where else do you go? What are some good resources that you would recommend?
There aren't any. That's really the problem, is that when you look at the academic scholarship, monetary scholarship really dried up in the 1970s. And really between the 1980s into the 1990s and 2000s, all this important innovations and inventions went unexplored. And so really nowadays we have, as you said, Joeri, there are economists that are working to catch up. For example, for Collateral, one of the most prominent voices is a guy who works at the IMF. His name is Manmohan Singh, who's been talking about collateral, multipliers, all that stuff, rehypothecation, reuse rates. But it's really, there's not like you can read a textbook. There's no book out there that you can go to and flip through and say, I understand the Eurodollar system. It's really digging through this primary source material and trying to put all these pieces together. That's why I use the analogy, my logo is a black hole, because this Eurodollar system, we can't observe what's going on in the banking system because they don't want us to observe it to begin with, but it's unregulated, it's unmonitored. And so we have to try to reverse engineer what's going on in the monetary system by how all of these things are affected by it. So when we see something like the 4-week Treasury bill price go way up and the yield go way down, we can realize, okay, I can't see that there's a collateral problem, but I understand that there's probably one there. So really what we're left to do is to put all these pieces together, and nobody has done that yet. I'm doing that at Eurodollar University, where I've gone through these videos, and we've gotten into the non-banks. We've gotten into ABS issuers. We've gotten into money market funds and how they relate to all these things. But nobody has really put together what this thing really looks like, because up until now, everybody's just been happy to just say, well, it's all about QE. It's all about central bankers. Even to this day, we're willing, most of the public anyway, is willing to let the benefit of the doubt rest with central bankers. And so if you take nothing else away from the discussion, number one, it's more complicated. And it's not just more complicated for you and me, it's more complicated than the central bankers let on too. So it's really about understanding, trying to make sense. If you see something that doesn't look like it makes sense from what you hear, it's probably the case that it doesn't.
Okay, Jeff. So here I'm going to disagree with you a little bit, because I do think there are some really good sources on this stuff. If you want to get into this stuff, there are some really good academics that work on this. And I wonder if you don't know about them, let me know. But like, for example, some names that come to mind for me is Perry Merling, Professor Perry Merling from Columbia University. Even has some really good courses on Coursera for free, I think, talking about lender of last resort, shadow banking, repo, and what he does is all in balance sheets. And I think balance sheets are a very good way to make sense of all of this. And then there's also, for example, if you follow on Twitter, Professor Daniela Gabor, who writes a lot of papers on shadow banking, market-based finance, and all of this. And if there's a more mainstream name, then I would say there's Professor Marcus Brunemeyer from Princeton, who has written, I think, a really nice paper in detail about how the global financial cycle, not the global financial cycle, that's something else, the global financial crisis, the great financial crisis, how this sort of unwinded and how these different institutions there was contagion. So one fell, then the other, and then he describes in great detail how this led to what he calls funding, liquidity shortages, and liquidity spirals. And he does talk about collateral a little bit, but these are small groups of people, right?
And I still think they're missing a huge part of the discussion. I'm familiar with their work, and I think that they're missing a lot of it.
Okay, so
let's
get into
they're looking at it around the edges and sort of probing into some of the stuff, and there's still so much left that needs to be worked on.
Okay, wait. So that we'll get into next, because I have some good news for you. I just had a look at the chat, and people totally seem to disagree with me. They were saying, go further into this rabbit hole. So let's do that. Let's do that. Okay, then one last name that I read quite a bit, Zoltan Pozar. You probably know analyst. No. No, you don't like that?
No.
Okay.
Oh boy,
okay, that's interesting.
See, that's
why not?
talk about going in the wrong direction.
Okay, so interesting. So maybe let's take this broadly. So these scholars, they do talk about shadow banking. They do talk about collateral. Where do you disagree?
I pick one. I mean, what topic do you want to talk about? I mean,
Okay.
Zoltan's entire focus is on bank reserves. I mean, he just came out with this whole Bretton Woods 3 thing, which I mean, I just have to laugh at, because he's saying the system is so now is so happy with the Federal Reserve and all its various programs like FEMA and overseas dollar swaps that everybody's going to ditch their U.S. treasuries and start, redo the dollar system, the Euro dollar 3, I think he called it, based on commodities.
Yeah. Okay. So
I can't stop laughing. He just doesn't.
I didn't follow that one too. He did kind of lose me there.
Zoltan has never said the word collateral in his life. Okay. So the next time he does will be the first time, which you just cannot analyze the monetary system in any realistic way without at least starting with collateral. Forget bank reserves, forget deposits. Collateralized interbank lending is the basis of pretty much everything that goes on. So again, he looks at, very complicated charts, very complicated discussions. He talks about shadow banks and talks about all those things, but how can you miss this other part of it? He's looking at one very narrow perspective and missing out on everything else, which is why everybody in the world is running toward treasuries when he said they'd be selling them, happy to use commodities as commodities as an exchange and settlement mechanism, when the Eurodollar system was the way to get out of a commodity-based settlement paradigm. So, I mean, it's like that with a lot of these people, is that they focus on one particular aspect of it, and they can't. It's the forest from the trees.
Okay, so for example, like if we can bring it back a little bit to sort of how it's important to understand the system if you're a macroeconomist, if you want to understand macroeconomic developments. So one thing that springs to my mind, is, for example, during COVID, at the start of COVID, you had this huge drop in treasuries. Now, the people that I typically follow were writing about this. Like, the problem here was that there was a run on collateral, I think, but at the same time, this needed to be sold. So I'm not entirely clear on this.
I'll tell you what happened.
All right.
Okay.
Let's do that.
In March of 2020, we had a massive dollar shortage. This is the part they don't want to talk about.
But what dollars? Reserves?
Foreign reserve managers were forced to sell their treasuries because the banks operated in their local jurisdictions were short of dollars. There was non-negotiable dollars. And so reserve managers did what they always do when faced with a dollar shortage. They sell their U.S. treasuries because the U.S. treasuries are the reserve assets that they liquidate and then use the cash proceeds to either lend or subsidize lending in their local banking system. But you don't just sell treasuries. It's more complicated than all of that. What most reserve managers have are off-the-run treasuries. Off-the-run treasuries are treasuries that have been issued in the past. And there's not really a liquid market available to them. If you want to sell an off-the-run treasury, you can find a dealer that will likely sell the treasury for you at a decent price, but there isn't a really liquid market. When we talk about the treasury market being deep and liquid, what we're really talking about are on-the-run treasuries.
So
those are the assets that are treasury? Just sold from the Treasury Department. So a 10-year note that is sold at last month's auction, that's on the run. The 10-year note that was sold 3 months before then just went off the run. The on-the-run stuff, which matches the closest parameters to the current market conditions, that's the stuff that's liquid. But if you have foreign reserve managers that only have off-the-run treasuries in their reserve portfolios, if one or two want to sell their off-the-run treasuries, that's not a problem. Most dealers will buy those off-the-run treasuries, usually not with their own capital. They'll take the off-the-run treasury and then fund the transaction in repo. So the dealer is borrowing cash from the repo market using off-the-run treasury to pay off the purchase from the reserve manager. That's no problem. It happens all the time. However, we had a massive dollar shortage that meant we had tons of reserve managers all trying to sell their off-the-run treasuries at the same time. And at the same time that happened, the repo market then looked at the off-the-run treasuries that were now becoming increasingly illiquid, and said, I don't want that as collateral. So dealers were forced to buy these off-the-run treasuries. They couldn't fund their purchases in repo because the off-the-run treasuries were not useful as collateral in repo, which meant that dealers were getting stuck with these securities they didn't want and couldn't fund. So what do they have to do? They got to sell them into the market where there isn't a market existing for them, which means they have to reduce their prices. Is that a problem of the treasury market? Or is that the problem because we had a dollar shortage that started the trend to begin with? But, see, everybody focuses on the treasury market when the issue is the dollar shortage at the start of it.
But let's zoom in on that a little bit, this dollar shortage. So you're saying, if I understand correctly, that this was overseas. So let's say in Malaysia or whatever, in Europe, right? Like, so there was a dollar shortage there with, I guess, firms, and they went to their banks, and the banks couldn't supply more dollars.
There's always a maturity mismatch. So again, we'll go back to our first example where, we have a company, a corporation that exists in Europe that wants to transact with Malaysia. We'll use Malaysia. So they need dollars to do that. Where do they get those dollars from? Well, the company in Europe contacts its local bank. The local bank probably doesn't have dollars, but it knows a dealer who does. So it's going to lend this corporation these dollars that it borrows in short-term markets. It's going to lend them at longer term, maturity transformation, nothing more complicated than that. Mm-hmm. But now this company, this bank in this local European jurisdiction has an illiquid longer term loan that it is funding in short term markets. And if you have a disruption in those short term markets, then you have a liability mismatch on the local bank's balance sheet. Because now it doesn't have the dollars to fund its longer term asset, which is a loan to this company. And if you can't borrow them in short term wholesale markets, then these local banks, this European bank will contact the ECB or the National Central Bank and say, I can't fund this stuff. I can't fund this asset, this loan that I've already created in US dollars. Can you help me out? Mm-hmm. And the European National Central Bank will say, yes, I can help you out. I'll sell some of my treasury so that you can close out your position. We won't have any dollar funding problems or anything like that. So that's what usually happens. We have a maturity mismatch, funding mismatches, as well as central banks and reserve managers and governments that step in when they need to because they realize the consequences of not stepping in are something like 1997-98's Asian financial crisis.
So the shortage is in the euro-dollar market then? So like coming back to why we all need to understand the euro-dollar market, that's where the shortage is.
And then, think about it from the perspective of dollar providers in the euro-dollar market. It's March of 2020. Governments around the world say we're going to close the economy. We don't know what this is going to look like. So as a dollar provider, you would quite naturally say, I'm going to yank all my funding transactions and everything back as I possibly can because I don't know what the risks are. And there's nothing that kills dollar providing more than uncertainty, because you put that into any kind of quantitative model, a high level of uncertainty generates a ton of expected losses. Mm-hmm. So uncertainty kills monetary resources faster than anything.
Yeah, and
so a high level of uncertainty, less dollars, that triggered this cascade of reserve managers selling that just gummed up the works even further.
And going back to our sort of beginning discussion of looking at the money supply as being elastic, so it was basically shrinking the euro at the euro-dollar level.
You had an elasticity where the supply curve was probably almost vertical.
And all of these international banks then went to all of their local central banks, whether it be big or small, European Central Bank, Korean Central Bank, Malaysian Central Bank, and they were like, okay, I can provide this, but I have to sell treasuries to try to get dollars or reserves then internationally. What were they trying to get? Reserves? Or
they were trying to get whatever liability would allow their local banks to square their balance sheet shortfall.
So that could also be, for example, a deposit.
It could be repo. It could be derivatives.
Or
absolutely, yes. It could be HSBC. It could be a Japanese bank. It could be anybody around the world who claims to have spare dollars, operates in the system, and says that they're willing to provide them. But what the Eurodollar system, these private banks said was, we're not willing to provide them because there is way too much uncertainty in the marketplace. And that just triggered this cascade of selling because everybody was faced with a monstrous dollar shortfall, led to monstrous treasury selling. And unfortunately, ever since then, central bankers have been patting themselves on the back for trying to bail out the Treasury market, what they see is a Treasury market problem, without ever confronting the dollar issue that started it.
But then one thing that does confuse me in how it fits with your worldview, and that is, didn't the central banks then sort
Overseas
of
dollar swaps.
Wait, what about dollar swaps?
The central banks came in later and said they fixed the problem with FEMA and overseas dollar swaps. This is Olton's thing.
And with quantitative easing, I think, right? But
no, they didn't. That's not it at all.
No, I think you would say that, but I'm just saying that this is also
That's
part of the story.
The
right?
idea was, if you listen to what the Federal Reserve says in particular, and there's any number of papers that have been written about this, and I just shake my head. They say that the Fed came in and fixed a Treasury market liquidity problem by buying these off-the-run treasuries.
Yeah,
but it wasn't a Treasury market liquidity problem, and the buying of the treasuries didn't fix anything. Because when the Fed announced QE, which was March 15th, it was on a Sunday night, if you remember, we had all sorts of massive illiquidity the next day and the rest of the week. So the buying of the treasuries, the announcement, the overseas dollar swaps that are supposed to be effective in this kind of a situation where banks can access their local central bank, their local central banks that are auctioning US dollar liquidity funded by these dollar swaps, absolutely nothing. There was no activity in the dollar swaps until I think it was March 22, going off the top of my head, don't quote me. But anyway, nobody was using the dollar swaps when they could have been, because the dollar swaps are worthless. They don't actually help. The problem was in a different part of the system that nobody ever focuses on. Instead, we're supposed to congratulate Jay Powell for bailing out this Treasury market problem by buying a bunch of off-the-run securities, when nobody asked why there was so much selling of the off-the-run securities in the first place.
But then you are suggesting that they did buy them, and that would solve, logically speaking, this illiquidity in the Treasury market, right? If the illiquidity means there's no buyer for my treasuries, and then you're saying that the Fed did buy them, then why isn't that problem solved? Like, okay,
because it still doesn't solve the Eurodollar problem that sparked everything. The issue is not the selling of the treasuries. The issue is why you're selling the treasuries in the first place.
Yeah. Okay.
So if you're just going to willing to come and buy some treasuries after this other massive disruption happens, that's not the same thing at all. In the Fed, they admit this. They say the Federal Reserve is not a central bank in the old Walter Bagehot model of lender of last resort. They're now what they call market of last resort, which is entirely different. What you're saying is there's a huge problem that happens, and then at the end of it, we try to clean it up.
Yeah, but okay, so they did clean it up, though. No, I understand. So the difference is a little bit like, if somebody gets hit by an axe or something, and they patch it up. It's good that they patch it up, but it doesn't solve this crazy dude with an axe, or like.
Exactly. There's still a guy running around with an axe, so that's the issue.
Okay, yeah, but I just did want to clarify that they, in your opinion, they did patch it up, but it's just like they also need to look at the root cause. But
yeah, and I would argue about the effectiveness of the patching it up too. I don't think it was as effective as was claimed either. And I think that really the liquidity problem didn't end until the U.S. Treasury issued more Treasury bills. I think that was more effective in ending the crisis, because we had a collateral shortage too. The other part that I didn't talk about before, as these off-the-run treasuries became less and less negotiable in repo, that meant the only collateral usable in repo were on-the-run treasuries. So there was a massive shortage of on-the-run treasuries, which, after the CARES Act was passed late in March, meant that the U.S. Treasury started selling lots of treasury bills into the marketplace, which probably had a much more effect on liquidity, collateral use and reuses and availability than anything the Federal Reserve did.
All right. Jeff, this is something I need to process a little bit, to be honest.
I would imagine. And by the way, that's the reaction I get all the time. It's really, first of all, it's too much. It's too much all at once, and it's outside the mainstream thought. But you can see that there's something here. Like I said, if you take nothing else away from this discussion, it's that there's at least a lot more going on behind the scenes than you think there is.
So one thing that I do find interesting, and this is I hadn't heard before, so that you make this distinction between two types of treasuries, like on the run and off the run, and as I understand it, you mean like just issued and issued a long time ago, right?
Right.
But I don't understand that if you're saying that there's a shortage of these off the run treasuries. But later it was fixed by the federal government issuing all of these underrun treasuries. Like, how does that work?
Because you got to think about the collateral system, as we talked about, as a collateral system. So if these off the run treasuries, if you're trying to use off the run treasuries into the repo market and the repo market's rejecting them, in order to fund yourself, you can no longer use off the run treasuries. You have to use on the run treasuries to make up the difference. Mm-hmm. But if there aren't enough on the run treasuries that not, whether it's supply from the government, whether it's further reuse from dealers and securities lending practices, whatever the case may be, there has to be on the run treasuries to make up for these off the run treasuries that are no longer usable in repo. Because you have to keep in mind one thing when it comes to collateral and repo. The repo counterparty only cares about the liquidity characteristics of the collateral they're accepting. I've lent you cash. You've given me a security. The only thing I care about is if you default tomorrow on that cash, I have to be able to sell your security, right? Because I have to sell the security to get my cash back. Mm. And if I look at that, if you're giving me some kind of collateral where the market is breaking down, I don't want anything like that collateral because I'm no longer assured that I can get my money back tomorrow because I don't know if I can sell it. So where you might have given me an off-the-run treasury yesterday to do our funding transaction, if the off-the-run treasury market starts to go illiquid, I'm going to say, no, I don't want this off-the-run treasury. The market forward is breaking down. If you want to borrow my cash, you got to give me an on-the-run treasury, which treasury bills, all treasury bills are on the run. So treasury bills are the best of the best of the best form of collateral. And so if we can't use off the run stuff, it herds everybody into what is usable, where there is a dependable marketplace. So a greater supply of on the run treasury bills does help make up for the shortfall where you might have used an off the run treasury yesterday, but all of this malfunctioning has made it non-negotiable in repo. Go find yourself a treasury bill, see if you can rent it from JP Morgan, and then we'll talk.
Okay.
So if JP Morgan has more treasury bills and they're willing to lend them to you, then we can do business.
So it's a system where the one thing depends on the other, and so the government issuing more treasuries fixed this higher up problem in the system, and when that was fixed, sort of the lower market that could then absorb these off the run treasuries was fixed.
It starts to normalize. Things start to unstick, right? Because you start to do a little bit of business and a little bit of more business, and you relax a little more, and it has this cascading effect.
Right. Okay. So let's put it like this. So I have this is stuff that I do read about, but I'm not someone like you whose core competence is this, right? So, but this conversation so far has really helped me to fill in some of the missing pieces that sort of, if you think about this global financial system as like an onion that you have to unpeel, sort of I think in a layer fairly high up, but this has helped me sort of put some of the puzzle pieces together that I wasn't before. So thank you so much for that, Jeff. And I do think this is a great moment to see if there are some questions, because last time I checked, everybody was like, okay, keep going down that rabbit hole. But now I want to see I think we went down that rabbit hole. Of course, not completely. This is a massive system. We cannot discuss this whole thing in one conversation. But let's see if there are some questions. Does that sound good to you, Jeff?
Sure.
All right. Let me see. Just gonna check now. There we go. Okay. I think here's an interesting question. I'm not sure if it is to you, but let's talk a little bit about now. So if you're saying that QE isn't effective, and so it's on the house is saying that's his username. What should the Fed do then?
Shut down.
You're gonna have to explain that a little bit. Are you on the team of shut down the Fed or abolish the Fed, or no? Right?
For very different reasons. Very, very different reasons. Most of the abolish the Fed people are because they think the Fed has printed too much money. I'm sort of, we don't need the Fed because the monetary system does its own things either way. So it's the Fed's sort of superfluous.
Wow.
So
Okay.
what does the Fed do? In very broad, big picture terms, what the Fed needs to do is more of what Joeri's talking about with these people he follows. It needs to go back to its roots. It needs to understand the monetary system, which is its job. See, that's the part that really bothers me the most, is the Fed's job all along. And what they told the public was that they were the monetary stewards, when that was not the case. They had no idea what's going on in the monetary system. So to fix this problem, and I would prefer the Fed not do this, but I can understand people want a public utility that's supposed to operate like Walter Bagehot said, in the old sense of a central bank. So they need to go back to their roots. If we're going to have a central bank, let's have it actually be a central bank that understands the monetary system, actually monitors it, and where able can affect some useful, helpful influence over it. And the Fed is here, monetary system is way over here. They'd have to close a lot of that gap, which, as Joeri's pointing out, there are people who are trying to do that. But they need to do it more. They need to do it more urgently, and they need to do it more determined effort.
Hey, and this is not really a question, but someone is saying something now that I think is maybe in line with what you're saying is. This may sound nutty, but interest rate may be at zero within 6 to 12 months again. What do you think about that? The yield curve seems to indicate something like that. Maybe not so low, but what do you think?
No, I mean, I look at the Eurodollar futures curve, which is obviously tied to 3-month LIBOR. So that's a bet on where short-term rates are going. It's inverted almost 200 basis points, that's basically saying the yield curve is looking at probabilities where interest rates, in the next couple of years, it wouldn't be at all surprising if we're at 0% interest rates and more QEs. That's what that level of inversion in the Eurodollar futures suggests. And it's only joined by the U.S. Treasury yield curve. We look at swap spreads and things like that. The market is preparing for interest rates to go down relatively quickly. And as we said before, central bankers not knowing what else to do once they get to the zero lower bound, or what do they call it now? The effective lower bound. Once they get to the zero nominal lower bound, there's going to be more QEs. It's just what they do.
All right, interesting. Okay. So with that, I don't see that many more questions. I think the audience also needs some time to let all of this sink in. And this interview will be published. It will be edited a little bit and will be published on the second channel, Money Macro Talks. I'll also try to make some clips because we've discussed so many subjects. I think that's perfect for like small chunks as well. So please be on the lookout for that. And with that, Jeff, I just want to thank you for this conversation. It has really helped me at least in two ways. It has helped me in two ways. First, I think you have a completely different perspective on this. As we noted, I do think about the Eurodollar system quite a bit and the history of it, but the people I follow have a different perspective than you, and specifically that they would argue that the system has created too much liquidity. You're the first person I spoke to who said it hasn't created enough liquidity. So that's definitely something that I will think about, and I hope the audience will also think about. And then second, I thought it was also super interesting that we went a little bit deeper into how the treasury market functions, and that there are these different treasuries that might depend on each other and where the system might get stuck in a way that we don't think about. And I think this underscores sort of the point that we started out with, that it's just, if you want to be a good macroeconomist, so if you want to understand in a COVID crisis that government bonds are crashing, that's macroeconomics. You need to understand how this very complicated market works. And for that, there's Jeff Snider. And I will explore some of these topics as well, money and macro. But definitely check out Jeff Snider's Eurodollar University on YouTube is, I think, a good place to start. So thank you so much, Jeff. Is there anything you want to close off with to the audience, or are you happy as is?
No, like I said, I think the most important takeaway that I get whenever I have these chats, and again, thank you, Joeri, for inviting me. I always appreciate it. And I do realize, What I have to say usually is not something anybody else has heard before. But if nothing else, I just hope to provoke those same kind of questions that you talk about. That understand that there's more there to be discovered, to be understood. It's more complicated than it's made out to be. And if you start asking those questions, I'll be happy. Even if you come to different conclusions than me, that's perfectly fine. Just start thinking about the monetary system again, because for a very long time it was left to, oh, it's just the Fed. Don't worry about it. It's all good there. So if nothing else, if we started to plant a couple of questions in your head, a couple of things like that, I'm perfectly happy.
Excellent. All right, then with that, let's close this to an end, and hope to see all of you on future live streams, and also watching future videos. This week, a crypto video will be coming out where I will be talking extensively about the use of collateral in the crypto markets these days. So very thematic, I think. Yeah, with that being said, thank you all so much for joining, and see you later.